Three big numbers on the way in the next 3 days and a final economic report card for the Biden-Harris administration before the election. Our senior economics reporter, Steve Liesman, has a preview of that. Good morning, Steve.
Good morning, Becky. Yeah, the candidates are going to watch these numbers for any opportunity, positive or negative, they might provide to score points on the economy. But I think Wall Street and the bond market, they're going to be watching even more closely for what it means for basis points on bond yields, which have been driving markets. ADP coming in at 113. That's a reduction, maybe perhaps reflecting some of the strikes and some of the hurricane issues out there. But GDP, pretty strong, 3.1%. PCE, 2.1. I don't know. I might call that victory for 2%, the 2% target, but the core a little bit elevated at 2.6. And there's the jobs number. We're going to talk a lot about this the next couple of days, but coming in at 100,000. Again, strikes and hurricanes maybe playing a role there, especially the potential for it to be affected, by the way, by those hurricanes. And moving on here, taking a look at the 3.1% forecast would represent a second straight number well above potential there, right in a row. And there's a pretty strong repudiation of the growth forecast. We had these really anemic growth forecasts for the second and third quarters that we saw at the beginning of this year. That didn't happen. Strong consumer spending, that's going to be behind this number here. But business equipment also doing pretty well. Big aircraft spending as well, helping while housing seen as a drag. And a quick technical note, the consensus may be a little bit lower in reality on the street because it may not include yesterday's stronger trade number, which of course subtracts from GDP. They may have been bringing stuff into the country ahead of either strikes or tariffs or who knows what. The candidates, they're going to make hay out of this number, but hey, the bond market's going to make profit and losses, and it's going to look like it will take weakness in the economy to reverse this upward reversal in yields that's raised yields more than 50 basis points since the Fed meeting. Just before the GDP number, we get ADP. That's a heads up on the jobs report. And a look at how wages may or may not be boosting inflation. Guys, a lot of talk about yields and what's driving them. Yeah. Torsten Slok, we all follow Torsten. We read Torsten, says this is maybe reflecting the fiscal outlook. Mm-hmm. Then I pick up the Journal this morning, and I thought they repeated a story. There's a $50 billion investment plan from KKR about energy and data centers, a $40 billion investment from Musk. I thought they were the same thing with different numbers, but that's $90 billion. Then I read this wonderful piece by our friend, remember John Sylvia? Yeah. Used to work, I guess, at Wachovia, whatever, went over to Wells. He's now working, I guess, for himself. He says, interest rates never end up anyplace. They just keep moving around to reflect the difference between the supply of savings and the demand for investment. Yeah. And we are living in a moment here of extreme demand, yes, from the fiscal side, but also from the private sector, which can't seem to raise enough money to build enough AI stuff all over the country.
That's a really interesting back and forth pull. I thought it was interesting that you said bond yields are going to rise on this, and the only thing that would push them down would be a reflection of weakness in the economy. I thought you were saying that that's why we've seen elevated yields, but it's not. I mean, it's a combination of factors.
Combination. You have growth you have out there. You have an expectation for, you had firmer inflation. And one of the things John points out in his column, I showed you those numbers, that 3% growth. Potential's thought to be 1.8. Well, depending upon the breakdown of that data, right? If a lot of that extra data is productivity, that's not necessarily inflationary. If some of that data is building infrastructure or building new plant and equipment that will add to potential growth, that's not inflationary. But if you're adding growth above potential without adding resources, that's inflationary. So, yeah, you might come along with firmer inflation, and also if you have a 4.1% unemployment rate, and that unemployment rate is below a kind of steady state, I think, then that could also add to it, which why, by the way, at, what time is it? 8:15 this morning. One of the best parts about the ADP report is their wage data.
I'm sorry,
their wage data.
Okay.
They have wage,
real data.
I guess we're going to have Neela in. I'm very excited. She's going to be in the show here. Their wage data comes from 10 million actual paychecks, which is orders of magnitude more than the government data on wages. So when they come through and tell us what's happening with wages, that's what we want to look. Really good indication of strength and weakness of the job market.
If there's a difference between what we hear from ADP and the government, do you say forget the government, go with the ADP number?
Of all the private sector pieces of data out there compared to the government, their wage data may be the most important. And it's been different. It's been a percentage point higher, but it's also been coming down as well.